Hi friends, Namaste. Welcome all of you to my channel. Today let's discuss about do the internal rate of returns and the net present value, which are the discounted techniques of capital budgeting rules lead to the identical decisions. First questions we are going to discuss today, and the next I would be discussing about what about the capital rationing. Under capital rationing situation, how we are going to draw the investment opportunity schedule, friends. So based on this background, now let's talk about first of all what about the background of today's discussion. And this is all about, friends, that's we know that the both NPV and IRR will give the same result, that is acceptance or rejections regarding an investment proposal. I'm talking about capital investment proposal in the following cases. The first condition is that project involving the conventional cash flow. That is the point, is that conventional cash flow that we assume in uh, finance basically while discussing the capital budgeting, when our initial outlay, that is the net cash outlay, is followed by a series of inflow. Okay, but in reality that may not be true again. And second one is that independent investment proposal, we assume that all investment proposal are independent to each others. And obviously, friends, net present value is the better approach from theoretical basis. And that's why when we talk about the investment decision, normally we compare our net present value of any project, and we select the project with we say that higher NPV at the certain cost of capital, which is also known as the discount rate. So that is the point. Intermediate cash flows refer to the cash inflows received prior to the termination of the project. But when we talk about from the practitioner point of view, the evidence shows that that is in spite of theoretical uh, is uh, is the importance of NPV. Financial manager prefer to use internal rate of returns. Okay, that is the point we are going to discuss today. This is the basis for today's discussion. Yeah, we can say that the background. Now, what about the case? Do the internal rate of return and the net present value rules lead to the identical decisions? Yes, provided two conditions are satisfied, as we discussed earlier even. So first one is that the cash flows are of the project must be conventional. That means during our initial investment, that cash flow is negative, while subsequent cash flows are positive. First point you need to understand. Second one is that project must be independent, meaning that project can be accepted or rejected without reference to any other project. We discussed the same thing about the background also. Now, what about the NPV profile, friends? So, NPV profile, we can say that is the graphical illustration of the NPV, net present value of a project at the different required rate of returns. You could see in our x-axis we have a discount rate, or you can say that cost of capital, okay, K, which could be noted by K, or sometime we use the as a R also. Okay, so this is y-axis, we have our net present value. So when we draw the line, I mean to say that this is the point where NPV is 0. So this is the called internal rate of return. Okay, when we have a two project and we solve the questions, then we could draw the overall net present value profile, friends. That is called NPV. Okay, profile. Now what about the concept of that is the how we could draw the investment opportunity schedule when we have a budget constraint. So budget constraint, simply we need to understand here, that is the capital rationing situation. We are not going to select the project even based on the overall, based on the capital budgeting technique analysis by using the different methods. Practically, we are not going to select the whole project. Yeah, any project. We accept the project or even we reject it. It depends on the our overall budget constraint. Okay, so that means priority of investment is very important. So look at the this case, friends. This company, this let's see the Tata company, the fast growing plastic company, is a has a 6 projects, okay, and we have a fixed budget of 2,50,000. This is just assumption part. And while the cost of capital is 10%, if the cost of capital is not given, we could estimate it. That is called weighted average cost of capital. Whatever the we are using the debt and equity, we could estimate the cost of capital of the project. Now draw the investment opportunities schedule and also point out the drawback of this approach based on the initial investment and the internal rate of return for each project given below. So these are the given information. We have a project is that A, B, C, D, E, F, friends, okay, and each project has a given our initial investment, and at the same time you are given the internal rate of return. So point is that at first we need to understand we are going to accept the project and we just order it, okay. That means we would first accept the project. We say that selection of the project is that under the budget constraint. So look after your first project C, which provide you project C, and the B provide you the highest internal rate of return, okay. So you can see here, so we have again A, B, C, D, E, F, okay. Now what about the project A? Project A is 12%. So what about the other project? Look at the term. So that means we have to rank it. Which project you are going to rank first? As I discussed earlier, project B provided you the 12% internal rate of return, which is higher than that of cost of capital, and which is the among the all project we have a highest internal rate of return. So we see that this is the rank first. Then what about the second one is that this is the rank 2. Similarly, rank 3, rank 4, rank 5, and lastly we can say that rank 6, okay. So we simply concern project like your, this is the ranking 4, and what about the ranking for this is the 4 1 2. So look at the term, that is that, so this is the initial investment data, we use it. So we have to find the cumulative cash flow. So project B we have a 70,000, so that is the 70,000 we say that, okay. Look at the project B. Now what about the B plus C then? Cumulative, we are talking about cumulative. What about the C project? We have a 1 lakh. So this will be now 1,70,000. Again, what about the third one? Third IRR is that is the BCE. So this is the 2,30,000. So that is the next one is that BCEA. So simply we have accumulated all, and accordingly our value is 4,60,000. But point is that how we could draw this investment opportunities schedule based on the given information. So again, look at the term, that is the in y-axis we have a internal rate of returns, and in x-axis we have a total investment, and this is our cost of capital. So cost of capital is R, we have a 10%, okay. This is the K. So when we draw this line, this line is called IOS, that is investment opportunities schedule, okay. So important point is that we are unable to accept all the project because of having the budget constraint. So that means look at our budget constraint, how much is the 2,50,000. So that means BCEA, look at the that is according to the schedule, we could see here that is the only project BCE should be accepted. Together they will absorb our budget of 2,30,000 only. While project AF are acceptable but cannot be chosen because of the budget constraint. Similarly, project D is not worthy of considerations because we are going to compare our internal rate of return and the cost of capital. If cost of capital is higher than internal rate of return, yeah, internal rate of return is lower than that of cost of capital, we are not going to accept the project, okay. That is the point. So one of the drawback of this approach is that we can say that there is no guarantee that acceptance of the project like your BCE, as I discussed earlier, will maximize the rupee return and therefore the owner's wealth, which is the main objective of financial management, friends. So it depends on the how we optimize our overall investment. So that means we could apply even the portfolio management concept here, and then we could decide about how we accept the project, yeah, results of the project. So under the budget constraint, we could apply the that's investment opportunity schedule, and this topic is very important, I'm telling you, because this not only for undergrad level, graduate level, and even in the financial management, you could find the well, that's very important concept, friends. Okay, these are the things that I would like to share today. If you like this content, please like, subscribe, and share my channel, that is the finance guru, Pawan Kumar Jha. Thank you all of you for watching this video. Please take care, all of you. Thank you.